All right, let's get right to it. The market is at a serious inflection point. Over the next 1 to 2 weeks, the price action is going to be a tug of war between some really bearish technicals and one massive catalyst. So let's break down the scenarios. So, this is the big question on everyone's mind, right? We've had a heck of a run, but the tape is definitely showing some clear signs of exhaustion. The question is this just a healthy pause, a consolidation, or is this the start of something a lot bigger? Okay, first up, let's look at the evidence for the bear case, because there's quite a bit of it. The technical structure, when you look across multiple really critical sectors, is under a whole lot of pressure. Momentum is fading, and it's fading for the first time in months. What we're seeing is a convergence at some make or break levels. The S&P is testing that 6630 to 6600 zone as we speak. At the same time, you've got the financials testing that $51 support level. You know, if that goes, it's going to be a major drag on the whole index. And look here, the semis, the SMH, has already broken its prior trading box. That's a huge warning sign coming from a leadership group. And it's not just the charts. When you look under the hood at the macro picture, things are starting to look a little shaky. First, we're in negative gamma territory. That means dealers are forced to sell into weakness, which can really accelerate a move to the downside. Second, check out credit spreads in tech. They're widening for the first time since 2012. That's a big signal of risk aversion. Third, the VIX is in a clear uptrend. And on top of all that, insider selling is really high. These aren't just one-off data points. They're all pointing in the same direction. But there is a huge counterforce pushing back against all this negativity. And it really comes down to one thing: NVIDIA's earnings report. This single event is powerful enough, and I mean powerful enough, to potentially invalidate that entire bearish setup we just walked through. $57 billion. Let that sink in for a second. That's what NVIDIA reported in quarterly revenue. This isn't just a beat, it's a number so massive that it provides a powerful tailwind for the entire AI narrative, and really, the market as a whole. And here's a look at that surprise factor. The street was looking for $55 billion. NVIDIA comes in and delivers $57. In a market that was desperately looking for a reason to rally, this beat was like a massive shot of adrenaline. But, as huge as that revenue number was, it was the guidance that really lit a fire. A Q4 forecast of $65 billion just absolutely crushed estimates. You combine that with 75% gross margins, well, this report proves the thesis that all this AI spending is dropping straight to the bottom line. And the price action itself was significant, getting pulled right toward that $200 strike, which was a huge level in the options market. So, you see the setup, right? We've got these two massive opposing forces basically in a tug of war. This creates two very distinct scenarios for the next couple of weeks. The path we take is going to depend entirely on which of these data points the market decides to follow. All right, so here's your playbook. This is the checklist of what to watch. For the bull case to really take hold, the S&P has to hold that 6630 level, period. NVIDIA needs to hold its gains and push through 200, and we need to see the VIX break its uptrend and fall back below 20. On the flip side, the bear case gets confirmed if we see the S&P close below 6600, and especially if the financials break below $51. That's the trigger. Okay, so the bull thesis, in a nutshell, goes something like this. NVIDIA's report is so strong, it just lifts the entire tech sector with it. The market completely shrugs off this recent weakness, seeing it as just a healthy consolidation. Then, positive seasonality kicks in and carries us higher into year-end. The target there could be something like 650 on the QQQ. Now, this whole idea is completely invalidated if we get a daily close below S&P 6600. Now, on the flip side, the bear thesis argues that the technical damage is already done. The failure of S&P 6630 and XLF 51, that's the catalyst. It triggers a cascade of selling, which then gets amplified by that negative gamma we talked about. The market's focus just shifts away from NVIDIA and back to all that underlying macro weakness. This thesis is off the table if the S&P can get back above its 50-day moving average. Okay, before we get into some potential setups, we have to go through the mandatory disclaimer. This content is for educational purposes only. It's an aggregation of public sources to help you stay informed and sharpen your own decision-making. Please do your own research. This is not financial advice. And just a quick ask, if you're finding this analysis helpful, a quick like and subscribe really signals the algorithm and helps the channel grow. Your support is genuinely appreciated. All right, let's get practical. How could you potentially structure some risk-defined trades around these scenarios? Now remember, these aren't recommendations, just educational examples of how one might approach these theses. So first up, let's talk defense. If you're concerned about a breakdown below that 6,600 level on the S&P, a put-debit spread is a really risk-defined way to position for it. The idea here is to target a potential momentum-driven flush if that key support level fails. This setup is invalidated if the market turns around, rallies, and holds above 6,650. Second, a neutral play on the catalyst stock itself. Implied volatility in NVIDIA was through the roof heading into earnings. A structure like an iron condor is designed specifically to profit from that. You're betting on time decay and that inevitable post-earnings volatility crush, as long as the stock stays within your defined range. And third, a relative weakness trade. The Russell 2000 has been in a pretty solid downtrend, lagging the S&P significantly. So rather than shorting the whole market, one could focus on this weaker area using futures or put spreads. You're targeting that continued underperformance from small caps. This thesis is invalidated if IWM can somehow reclaim that 226 to 230 support zone. Now, this is absolutely crucial, so listen up. Options trading involves substantial risk. Your capital is at risk, and losses can exceed the premium you paid. You must always manage your position size and use stop discipline. And to wrap it all up, this is not trading advice. It's simply a market update to keep you informed. Markets carry risk. Always trade your own plan, manage your downside, and verify all data yourself.